Welcome to the Real Money Pathway, where I share my journey from financial collapse to lasting wealth. I'm David Kim, and I'll guide you through practical strategies that transform my finances and can transform yours too. Let's build your pathway to financial freedom.
The content of this podcast is provided for general information purposes only and do not constitute financial advice. Listeners should not act upon the content or information here without first seeking appropriate advice from a financial professional.
Welcome back to the Real Money Pathway. I'm David Kim, author of The Real Money Guide, the missing manual for financial recovery. Throughout our first 6 episodes, we've explored my recovery journey from financial collapse to rebuilding, covering everything from the psychological impact of financial trauma to emergency funds through strategic debt management approaches. Today, we're addressing something that many people face after financial setbacks, but few discuss openly: rebuilding banking relationships after severe financial challenges. And I want to start with one of the most humiliating moments of my post-bankruptcy life. It was about 2 months after my bankruptcy filing. I was standing in line at a grocery store with a modest $27 worth of basic food items. When I swiped my debit card, the terminal displayed a message I'd never seen before: card not valid. The cashier tried running it again with the same result. As the line grew behind me and my embarrassment mounted, I had to admit I couldn't complete the purchase and had to leave my groceries behind. What I discovered later was that my bank had closed my accounts without notice. This experience taught me something crucial. Banking relationships represent the foundation of financial participation in modern society. Today's episode is about rebuilding those essential relationships after they've been damaged or destroyed by financial hardship. We'll explore the banking reality after financial collapse, strategies for finding institutions willing to work with you, building a functional account structure during recovery, rebuilding your banking reputation over time, and eventually transitioning back to comprehensive financial services. Because the truth is, banking access isn't a luxury, it's a fundamental necessity for financial recovery. And despite what that humiliating grocery store moment suggested, there are pathways back to full financial participation regardless of your history. The banking landscape after serious financial setbacks can feel like navigating a completely different world than what you had experienced before. What many people don't realize until they face financial challenges is that banking relationships operate on historical trust. And when that trust is broken through bankruptcy, overdrafts, or account closures, the system responds with significant barriers to reentry. The mechanisms behind many of these barriers is a database called ChexSystems, essentially a credit bureau for banking relationships rather than lending. When you have a negative item reported to ChexSystems, whether unpaid overdraft fees, involuntary account closures, or excessive non-sufficient fund incidents, this information follows you for up to 5 years, affecting your ability to open new accounts across most major banking institutions. I discovered this system's impact firsthand when establishing a new account after bankruptcy. Within a single week, I was rejected by 3 major banks despite bringing documentation of my bankruptcy discharge and current income. Each rejection referenced account history information without specific details, leaving me initially confused about the exact reason for denial. After researching my situation, I requested my ChexSystems report, similar to obtaining a credit report, and discovered multiple negative items stemming from my financial collapse. These included 2 overdraft charges that had gone unpaid during my most challenging period and an involuntary account closure from my previous bank. These seemingly minor issues had created a significant barrier to my banking services. This experience revealed how financial exclusion operates in practical terms. Without banking access, I faced multiple challenges. Check cashing services charge substantial fees, typically 1 to 3% of the check amount, creating almost a poverty tax on my limited consulting income. Bill payments required purchasing money orders or paying in cash, adding both cost and inconvenience to routine financial management. Savings became significantly more difficult without secure account options, leading to less secure cash holdings. Financial documentation for housing applications and other purposes became complicated without standard bank statements. These practical challenges created significant obstacles to financial recovery, making it harder to implement many of the foundational practices we've discussed in previous episodes. Without stable banking relationships, even basic money management became unnecessarily complicated and expensive. What made this situation particularly frustrating was the circular logic it created. I needed financial stability to rebuild banking relationships, but banking relationships were necessary to create that financial stability. Breaking this cycle required understanding both the formal and informal systems that controlled banking access. Beyond ChexSystems records, I also discovered that bankruptcy filings themselves often trigger banking restrictions regardless of your account history. Some institutions have explicit policies against serving customers within a specific time frame after bankruptcy, while others implement unwritten restrictions based on credit reports rather than banking history. Credit scores also affect banking relationship access more than many people realize. While basic checking accounts theoretically don't involve credit, many banks use credit history as a risk assessment tool for all relationship types. My post-bankruptcy credit score in the low 400s created additional barriers beyond the specific ChexSystems issues. For those facing similar challenges, understanding your specific situation provides a foundation for effective solutions. I recommend taking these concrete steps to assess your banking access barriers. First, request your ChexSystems report through their official website. This free report reveals specific banking history items affecting your account eligibility. Second, review recent account closure notices or rejection letters, which sometimes contain specific reasons for adverse actions. Third, check your credit reports to understand how they might be affecting banking access beyond specific banking history issues. And fourth, document any unpaid fees or unresolved issues with previous banking relationships that might require resolution before moving forward. This assessment process helps identify whether your challenges stem primarily from check system records or your credit history, bankruptcy filing, or a combination of factors. Each source of banking restrictions requires slightly different approaches to overcome, making accurate identification crucial for effective solutions. What I eventually learned through this process was that banking exclusion, while challenging, is never permanent nor absolute. There's always a pathway back to financial inclusion, though they may require strategic approaches and persistence. The banking system maintains barriers to reentry, but they're barriers that can be navigated with the right knowledge and tactics. So now we move to the how we deal with these banking challenges after bankruptcy. After facing multiple rejections from mainstream banks, I realized that finding financial institutions willing to work with me would require a much more strategic approach than simply applying at convenient locations. This search became a crucial early step in my financial recovery, creating that foundation for subsequent rebuilding efforts. What I discovered through this process was not all banking institutions approach risk in the same way. While major national banks typically implement rigid qualification standards across their entire system, other financial providers often maintain more flexible approaches based on different business models, community focus, or specialized programs. My breakthrough came through a program I wasn't initially aware existed. Chase Bank's Veteran Banking Program. Despite my bankruptcy and ChexSystems records, my military service history qualified me for their Veterans Banking Initiative, which provided greater flexibility in account approval. Through this program, I secured both personal and business checking accounts that became the foundation of my financial rebuilding. This experience taught me that specialized programs often create exceptions to standard banking restrictions. These exceptions might include military-focused banking options that recognize service history. For those seeking banking partnerships during recovery, several types of financial institutions typically offer more accessible options than your major national banks. Credit unions often implement more flexible qualification standards based on their member-focused mission. As cooperative financial institutions, many credit unions emphasize community service alongside profit considerations, creating a greater willingness to work with those rebuilding after setback. My experience also with Navy Federal Credit Union demonstrated this approach. Though they noted my bankruptcy during the application process, my military service history and their mission driven focus resulted in account approval despite recent financial challenges. Community banks frequently make relationship based decisions rather than solely algorithm driven ones. Unlike national institutions with standardized policies, local banks may consider circumstances and personal factors alongside historical records. Online focused banks sometimes implement different risk assessment models than traditional institutions. Without physical branch networks, their cost structures and business models sometimes allow greater flexibility for certain account types. I was able to successfully open an online savings account through an internet bank that emphasized current deposit behavior rather than historical. This account provided a crucial savings vehicle when many traditional options weren't available to me. When approaching potential banking partners during recovery, keep in mind several strategies to improve your success rate. In-person applications generally yielded better results than online or phone processes. Face-to-face conversations allowed explaining circumstances beyond what standardized forms permitted, while demonstrating current stability and commitment to financial rebuilding. Documentation preparation also makes a substantial difference in application outcomes. By arriving with organized evidence of your current income, housing stability, bankruptcy discharge papers, I created a more compelling case than application forms alone would have provided. My Chase approval was significantly supported by bringing my consulting income documentation as well as my military history. Transparent communication about past issues and current solutions generally prove more effective than minimizing previous problems. By acknowledging bankruptcy openly while explaining my ongoing recovery efforts, established credibility that might have been undermined through partial disclosure. After 3 major bank rejections, I might have concluded banking access was impossible. Instead, I continued exploring different institution types until finding appropriate options, eventually securing relationships with 4 different financial providers. For those currently seeking banking relationships during your financial rebuilding, I recommend this systematic approach that includes researching institutions with histories of working with those in financial recovery, preparing a complete financial profile that includes your current income, housing stability, and explanation of those past challenges with recovery steps. Apply in person when possible. Request meetings with branch managers or lending officers rather than just relying on a teller-level application. Be prepared for initial rejections. They happen. And recognizing that they represent a specific institution rather than a universal banking exclusion. Consider secured account options that reduce institutional risk through upfront deposits, creating opportunities when standard accounts may remain unavailable. The most important insight from my experience is that banking relationships during recovery often begin with less than ideal terms, but they do improve over time. Initial accounts might carry higher fees, more restrictions, fewer features than you're previously used to. Accepting those temporary limitations while demonstrating positive banking behavior creates pathways to better options as your history improves. Once you've secured initial banking access, the next critical step involves creating a functional account structure that supports financial recovery. This goes beyond simply having a checking account to developing a comprehensive banking system that facilitates effective money management, savings accumulation, and financial progress tracking. During my early recovery, I discovered that banking structure significantly impacts financial behavior and outcomes. The arrangement of accounts, their specific purposes, and the workflows between them either support or undermine my broader financial goals. My post-bankruptcy banking journey began with a single checking account obtained through that Chase's veteran program I talked about. While this created basic financial system access, I quickly realized its limitations for supporting comprehensive recovery. A single account created commingling of funds that undermine the allocation strategies we discussed in previous episodes, while providing limited visibility into specific financial progress areas. Over approximately 18 months, I gradually built a banking architecture that was a structured account system specifically designed to support financial rebuilding. This wasn't about account complexity for its own sake, but rather creating a functional system aligned with recovery priorities and behavioral needs. This is what the core structure looked like. First, a primary checking account that one at Chase served as the central hub for regular income and essential expenses. This account received my quote salary transfers from my business accounts and handled routine bill payments and everyday spending. By maintaining balance thresholds aligned with monthly necessities, this account created financial stability without excess funds that might trigger impulsive spending. Next, a dedicated emergency fund savings account specifically for unexpected expenses. As we discussed in our emergency fund episode, this segregated account created both physical as well as psychological separation between emergency reserves and everyday money. The separate account reduced the temptation to use these funds for non-emergency purposes while visibly tracking progress towards savings goals. Next, a business operations account for managing my consulting income and expenses. This dedicated account created clear separation between business and personal finances, a distinction crucial for both tax management and financial clarity. All client payments went directly to this account before systematic transfers to personal and other accounts based on specific allocation rules. Then a business tax reserve account exclusively for estimated tax obligations. Given the self-employment tax responsibilities associated with self-employed consulting work, this separate account ensured those tax funds remained protected from both business operational needs as well as personal spending. The automatic transfer of 30% of all business income to this account prevented the common challenge of reaching tax deadlines without sufficient reserves. This is one lesson I learned early on and was created after I was hit with a huge tax bill in my first quarter after starting my independent consulting work. This structure evolved gradually based on specific needs and expanding relationships. During early recovery with limited banking access, I maintained a simpler structure with fewer accounts, adding components as both financial complexity and institutional relationships developed. For those of you that are implementing banking structures during recovery, several practical considerations from my experience prove valuable. Account selection should balance features against fees. When banking options remain limited, accepting higher fees for essential services just might be necessary, but temporarily. However, actively seeking fee reduction opportunities as your banking history improves creates savings over time. During my first year of recovery, I paid approximately $15 monthly for basic checking services. By my second year, I was able to switch to an account with all of those fees waived, considering my positive banking behavior, which saved me $180 annually. Direct deposit relationships also create both practical benefits and relationship strengthening opportunities. By establishing direct deposit for consulting payments when possible, I gained both faster fund availability and fee waiver qualifications at some banking institutions. Account linking offers both convenience and sometimes fee reduction benefits. By connecting savings and checkings appropriately, I created simple transfer capabilities while qualifying for relationship pricing that reduced overall banking costs. Minimum balance management requires careful attention during financial rebuilding. Many accounts assess fees when balances fall below specific thresholds, creating potential cost traps during your tight financial periods. I maintained a simple spreadsheet tracking minimum requirements across all my accounts, ensuring allocation decisions wouldn't inadvertently trigger fees through threshold violations. Through all this, automation plays a crucial role in effective banking structures. By establishing automatic transfers between accounts based on income receipt rather than calendar dates, I created self-maintaining systems that required minimal ongoing intervention. When consulting payments arrived, automated rules immediately distributed appropriate percentages to tax reserves, emergency savings, and operating accounts before I can make discretionary allocation decisions. For those with limited initial banking options, several strategies can help maximize functionality despite account restrictions. Secured accounts often provide more features than standard second chance products. By placing security deposits, typically $300 to $500, I gained access to accounts with lower fees and fewer restrictions than non-secured alternatives, essentially investing in a better banking relationship. Online-only options also provided more flexibility than traditional accounts during my rebuilding. Several internet-based institutions provided savings accounts with really competitive yields despite my bankruptcy history, creating a pretty good emergency fund vehicle when local options remain limited. The most important insight from my experiences is that banking structure should evolve alongside your financial recovery. What serves during early rebuilding with limited options and resources will likely prove insufficient as your situation improves and needs become more sophisticated. My banking architecture expanded from that single checking account immediately after bankruptcy to a multi-account system described earlier during mid-recovery, and eventually to a comprehensive structure including investment connections, business banking relationships, and so on. This evolution should not be forced prematurely, adding complexity before it serves clear purpose. However, recognizing when your financial needs have outgrown your current banking structure allows timely adjustments that support continued process. As your financial recovery progresses and basic banking relationships strengthen, opportunities for more advanced banking restoration emerge. This evolution goes beyond simply maintaining accounts to developing comprehensive financial relationships that support wealth building rather than just basic money management. My own advanced banking restoration began approximately 18 months into my recovery journey, when improved credit, consistent banking history, and stabilized income created opportunities beyond basic accounts. This phase represented a transition from merely having financial system access to optimizing that access for long-term financial health. The foundation of this advanced restoration relies on relationship banking, moving beyond transactional interactions to establish partnerships with selected financial institutions. Rather than maintaining minimal relationships with multiple providers, I strategically consolidated services with two primary institutions that offered the best combination of services, terms, and growth opportunities. This approach created several significant advantages. Relationship pricing reduced or totally eliminated fees across multiple services based on combined account values and service usage. By consolidating my personal checking, savings, and some investments with one primary institution, I qualified for their highest relationship despite relatively modest individual account balances. The fee savings alone exceeded $350 annually compared to holding the same accounts across multiple institutions without relationship benefits. Expanded service access became available through established relationships that might have been unavailable through separate applications. My business line of credit approval came significantly easier through relationship factors rather than purely business metrics, creating financial flexibility that supported continued consulting growth. Simplified financial management resulted from integrated services with consistent interfaces and consolidated reporting. Rather than tracking accounts across multiple platforms, consolidating relationships created comprehensive visibility that supported better decision making. Personalized support developed through sustained relationships with specific bankers familiar with my financial history and goals. These relationships created both assistance during complex transactions and occasional exceptions during unusual circumstances. Secure credit cards through banking relationships often provide better terms than independent offerings. Approximately 12 months into my recovery, I obtained a secured credit card through my secondary bank with lower fees and a clearer graduation path. After 6 months of responsible usage, this card transitioned automatically to unsecured status while returning my initial security deposit, a progression facilitated by that existing banking relationship. Business banking services create substantial advantages beyond personal accounts for entrepreneurs and self-employed individuals. As my consulting practice stabilized, establishing comprehensive business banking relationships provided specialized tools that significantly improved my operational efficiency. Investment connections between banking and investment accounts facilitated wealth building beyond basic savings. The automated monthly transfers between my checking account and investment account streamlined wealth building while contributing to my relationship tier qualification at my primary financial institution. Premium banking services eventually became accessible through strengthened banking history, providing both practical benefits and psychological reinforcement of financial progress. My invitation to premium banking services, approximately 24 months into recovery, represented meaningful validation of my financial rehabilitation. The dedicated banker provided through this service created both practical assistance during complex transactions and occasional exceptions during unusual circumstances. Several strategic approaches significantly accelerated my advanced banking restoration. The timeline for advanced banking restoration varies substantially based on individual circumstances, but generally follows a progression from basic accounts through integrated services to comprehensive financial relationships. My own experience included several distinct phases. 18 to 24 months after bankruptcy was the transition from basic to relationship banking with some consolidated services and improved terms. Between that 24 to 30 month period, integration of business and personal banking relationships gained access to expanded services. 30 to 36 months, premium service qualification with dedicated support and specialized offerings. And 36 months and beyond created comprehensive financial relationships across banking, lending, business services, and investments. This progression represented not just improved services, but meaningful financial benefit that supported broader recovery goals. They reduced fees, granted better rates, enhanced tools, and expanded access, created both immediate and long-term savings advantages for wealth building. The psychological benefits of this progression proved equally valuable. Each banking relationship improvement represented tangible evidence of financial rehabilitation beyond just a credit score or account balances. These institutional validations provided meaningful reinforcement during the extended recovery journey, confirming progress in concrete, practical terms. For those currently in early recovery stages, recognizing this eventual progress creates important perspective. The restricted accounts and limited services of early rebuilding represent temporary way stations rather than permanent conditions. With consistent positive banking behavior and improving financial circumstances, the path to comprehensive banking relationships remain open regardless of your past challenges. Today's episode focused on rebuilding banking relationships after financial setbacks, and our practical takeaway this week provides a starting point for developing your own banking restoration plan. For those implementing banking rebuilding strategies, I recommend focusing on two specific actions this week. First, request your ChexSystems report through their official website if you haven't done so within the past year. This free report provides crucial visibility into specific banking history items affecting your account eligibility while identifying any errors that require correction. Second, evaluate your current banking structure against the recovery architecture we discussed. Identify potential improvements that would better support your financial goals. Even modest structural improvements like separating out your emergency funds from everyday money can significantly improve financial outcomes. Banking relationships represents that foundation of financial participation. Creating and strengthening these relationships provides both practical functionality for daily money management and essential infrastructure for long-term wealth building. Today we've explored approaches to rebuilding banking relationships after financial challenges, from understanding banking system realities to finding willing institutional partners, creating functional account structures, rebuilding banking reputation, and eventually developing advanced financial relationships. If there's one message I hope you take from this episode, it's that banking exclusion is never permanent, nor is it absolute. Despite system barriers and institutional rejections, pathways back to comprehensive financial relationships always exist for those implementing strategic approaches with consistency and patience. In our next episode, Rebuilding Credit, the step-by-step approach, will tackle another critical aspect of financial recovery. I'll share my journey along my post-bankruptcy credit score in the low 400s to today's score exceeding 800, along with specific strategies that created this transformation. We'll explore understanding your current credit reality beyond just the score alone, creating realistic rebuilding timelines with appropriate expectations, implementing initial rebuilding techniques that establish positive patterns, developing intermediate strategies as your profile improves, and eventually implementing advanced approaches that optimizes your credit score for major financial goals. I'll also introduce the credit rebuilding roadmap that guided my own recovery, a comprehensive tool now available on both our websites. As you move through the coming week, I encourage you to take at least one concrete step towards improving your banking relationships based on what we've discussed today. Whether requesting your ChexSystems report, researching second chance account options, or restructuring your existing accounts for better functionality, even modest actions create meaningful progress toward comprehensive financial participation. I'd love to hear about your banking relationship experience during financial recovery. If you're comfortable sharing, please visit realmoneypathway.com and let me know what strategies have proven most effective in your situation. Banking relationships provide the foundation for financial rebuilding, and appropriate relationships remain available regardless of your past challenges. Until next time, I'm David Kim. Remember, it's not just about money, it's about building your real money pathway to freedom. Thanks for joining me on the Real Money Pathway podcast. I'm David Kim, reminding you that financial success isn't about perfection, it's about progress. So subscribe now for more strategies, and remember, your journey to lasting wealth starts with the very next decision you make.